Hello, friends, and welcome. In the previous episode, we were discussing about credit risk funds and how some funds have lost a lot of money even in a single day. So, let's understand, as we saw in the previous episode, credit risk funds are investing in those companies whose rating is a little lower. Consequently, they get a higher rate of interest. Now, what has happened is a few companies have defaulted on their interest rate payment. So, let's say the interest was due on the 30th of May. For whatever reason, either they had cash flow problems or they couldn't arrange the money, they defaulted on the payment. Now the rules are such that if a company defaults on payment of interest, automatically that much percentage of holding has to be written down. So let's say you are a mutual fund who had invested 10% in one company and overnight this company defaulted. You have to take a hit and you have to mark down your NAV by 10% which you are holding. So overnight your NAV falls from 100 to 90. Now there were some funds which were holding a little bit more than 10% in such companies, and consequently their NAVs have fallen, as I said, by even up to 26% in a day. There have been some funds whose NAV has fallen by 2%, 3%, 5%, even 7%, depending upon how much was the allotment, was the proportion of money which was invested into that particular company. So what does this mean? Should we stop investing in credit risk funds? Why does a person invest in a debt mutual fund? A person invests in a debt mutual fund because he wants stability of returns, a sort of capital protection with a surety that he will get a little bit more than what he is getting than what he would have got in the bank. So if you are that type of an investor, then clearly a credit risk fund is not for you. You need to be looking at other funds which are much safer. Let's talk about those in the next episode. See you there.